All right, so everyone in the class, very welcome to the session. My name is Adish, and in this video, we're gonna discuss all the new questions asked by the institute in its exam papers, RTPs, MTPs in the past 3 attempts. Which means for the in the attempt of September 25, May 25, and November 24, whatever new question asked by the institute in the RTP MTP exam paper, we're gonna discuss all those questions along with the solution, only the new questions. So this video, everyone is going to be in full English. Similarly, एक और वीडियो रिकॉर्ड करने का प्लान है जो हिंदी इंग्लिश मिक्स लैंग्वेज में रहेगा, which you can also refer. Right? So let me very quickly explain. We will talk about a PDF, right? Our very renowned PDF now new question by ICI that will come up with every attempt. This PDF has compilation of all new questions in its RTP MTP exam paper, right, by the institute of at least the last 5 attempts, right. This PDF has last 4 to 5 exam papers, etc. things, but I think it should be 5, not 4. It must be a mistyping, I believe, right. Anyways, this PDF you can get in the Telegram channel. The link to the Telegram channel I will give in the description of this video, right. Now in this video we're gonna discuss it only for 3 attempts, right. So let's get started. Meaning to say, who all should refer it? Any student who has taken my batch or not taken my batch. If you have taken any batch in the last 1 year, 1.5 years, then in your book, in your batch, these questions would not have been discussed, right? So those, along with the batch, along with the book that you're referring, if you refer to this file, it will be all sufficient for you to get into the exam hall. Perfect. So great. Also, I said power batch people, the power batch that we come up with, power batch people, as I said, you will have to also refer to the new question by ICI video. So this is the video that you will have to refer to. I'll also get this video uploaded on your Google Drive. Yes. So boss, finally, let's get started. We will go in a reverse chronology first, and in this video we're gonna talk about only the practical question, not MCQs. For MCQ we'll have a different video we'll come up with. Sir, for the attempt of September 25, if I talk about the exam paper, hold on for a minute. September 25, people in the class, just 1 second. Yes, so this is the file. As I said, it is at least about the last 5 exam paper. It is all updated till September 25 exam paper. I've seen the RTP MTP. I've seen the RTP of Jan 26. There's no new practical question. For Jan 26, as the MTPs are out, kindly make sure you go through those MTPs. If there's a new question, you cover it up, which is generally not there in the MTPs. So with the MTP discussion, you will be all set to go to the exam hall. Along with this file, obviously, and along with your existing notes and lectures, right, you will be all ready. So starting with the discussion, we will go in the reverse chronology. Just for your information, we are also going to come up with the full English theory marathon for the attempt of Jan 26 and onwards, for which you will also get a theory PDF. It is all, based on the study material language. The topics are very well organized. Along with every topic, we have also given to you the questions that have been asked by the institute in the past based on that particular topic, right? So in a startup finance, there are 10 topics. So before every topic, you will have the compilation of previous questions that is asked by the institute. Yes. So fine, that's great, everyone. September 25 exam paper. If I talk about the practical question number 1, let's talk about it. PN Limited submits following detail for the financial year 31st March 2025. What are the details? Number of equity share is 1,50,000. Current market price is 12. 10% debt company has valued 2 lakh rupee. Cash and cash equivalent, it has 5 lakh rupee. Gross profit of the company 12 lakh. Indirect expense excluding debt and interest is 5 lakh. Depreciation is 30,000. Risk-free rate of return, market rate of return, beta applicable tax rate have been given. On the basis of above detail, you are required to calculate the following. What all do we need to calculate? First thing, the cost of equity of the company using CAPM. Now sir, for CAPM, I need RM, I need RF, and I need beta. Do I have the beta ready with me? Yes. Do I have the RM and RF? Yes. Super quick, everyone in the class. Sir, 16 minus 7 is RM minus RF into 0.8 beta plus RF of 7 give me 14.2 as my cost of equity. Next is earnings per share of the company. So now we need to proceed to, create an income statement. What in the income statement have we been given? Have we been given revenue? No, we have directly been given the gross profit. So from the gross profit, if I deduct other indirect expenses, so that is 5 lakh, I will get 7 lakhs as the next profit. What is that next profit? The next profit, everyone in the class, is EBITDA. Why? Because from this, in the indirect expenses, depreciation is not included, which means in this profit, depreciation has not yet been deducted, which is why earnings before interest, tax, depreciation and amortization, EBITDA is there. Fine. After which I'll have to deduct 30,000 of depreciation and 10% of interest on 2 lakh rupee debt is 20,000. So 30 plus 20 is 50,000 rupee of expense to be deducted. So profit before tax is 6 lakhs 50,000. So from the amount of EBITDA of 7 lakh, depreciation of 30 give me EBIT, minus 20,000 interest give me PBT of 6 lakh 50,000. From this PBT of 650, so 6 lakh 50,000 minus tax rate of 20% give me PAT of 520, and 520 PAT divided by 1 lakh 50,000 share. What's the PAT? 520 divided by 5 lakh 20,000 share, divided by 1 lakh 50,000 share give me 3.4666 rupee of earnings per share. Fine, sorted. C part of the question, value of equity if the applicable EBITDA multiple is 4. Sir, we need to find out the value of equity share. When someone gives you EBITDA multiple, please you have to understand what it is EV to EBITDA ratio. What is EBITDA multiple? EBITDA multiple is EV to EBITDA ratio, which is 4 times. With this word, with this line when you read here, are you able to relate it with the relative valuation, which we have learnt it in the topic of security valuation, business valuation, or in our book it is equity and business valuation, relative valuation. Sir, which means to the EBITDA, if you multiply 4, you will get the enterprise value. What was the formula of EV to EBITDA ratio? Sir, the formula is the name itself. EV to EBITDA ratio is equal to enterprise value divided by EBITDA. If we have known the EBITDA to be 7 lakhs, if we know the ratio to be 4 times, then can you find out EV? Yes sir, 7 lakhs into 4 give me 28 lakhs of enterprise value. Right, fine. We have not been asked the enterprise value, we have been asked the equity value of the company. Now we know that enterprise value has value of equity, value of debt, value of preference minus cash and cash equivalent. All that is equal to enterprise value. So if I have the enterprise value, let me deduct the value of debt from it. Preference, no detail has been given. Cash and cash equivalents has been given. We have to add it, right? So 2 lakhs when you deduct from the debt and cash and cash equivalent, as I say, has not been added, is a mistake by the institute. Sir, there is this ambiguity. Please observe. Please observe. There is this ambiguity this institute has done where cash and cash equivalents have not been added when it did calculated the enterprise value. Agreed? So that's an ambiguity. Sir, what do we have to do in the exam? If in case you find the same question in the exam hall, try to do the way institute has done it, which means ignoring cash and cash equivalent. However, please don't worry too much about such ambiguities. If you're not able to remember these things, don't worry, go natural to the exam hall. Try to solve it correctly, because we see a possibility that institute might rectify it and give an alternative solution to it. Right? However, first preference should be to be able to remember it. Sir, enterprise value was correct, equity value was incorrect. Moving to the next, enterprise value of the company. Sir, we just calculated enterprise value of 28 lakhs. Now what is the thing? You have to please realize there is a difference. One is the enterprise value that we calculate using the profits or EBITDA of the company, which means that was, everyone in the class, kind of fair enterprise value. Or maybe we can say it was a fair equity value, that if this is the profit, then how much will be the enterprise value? Deducting it will give me the fair equity value. Now when they ask you the enterprise value again, so this is the context of the question we will have to catch, that again the institute won't make you do the same question, which means this time it is asking you to calculate the enterprise value, which is the actual enterprise value, which is not based on the fair. It's not about the intrinsic value, it is about the actual value. Do you remember in equity business valuation we talked about the intrinsic value, the equilibrium price, what should be the price versus the actual price, which is what is the price. So what is actually the price, or what is actually the enterprise value of the company, is all based on the actual prices. For example, I have 1,50,000 share where price per share is 12. So 1,50,000 multiplied by 12 give me 18 lakh as the value of equity. Plus the value of debt is 2 lakhs minus cash and cash equivalent is 5 lakh. So 18 plus 2 minus 5. 18 plus 2 minus 5 give me 15 lakhs of enterprise value. This actual versus fair, this actual versus fair is the main thing or main point of understanding in this question. This ambiguity is also there, for which you don't have anything to do. Question 1 gets discussed. Second question is again a very brilliant question, basic and brilliant. The following details are given for TCPC Limited, right, and index for 1 year period. This company and market had an average return of 0.2, 0.18 and 0.6. Sir, did you observe something? Returns have been given in decimal terms, fine. Variance of return, what is the risk at squared level? 5.8, 4.8 and 2.1. Did you realize? Institute made a mistake of not giving percentage or decimals here. Institute missed here. But sir, how do we know? By applying common sense. For example, 5.8. Let's assume you might think, sir, it is decimal. So you multiply 10,000 to it to convert it to percentage. It turns out to be 58,000. When you underroot it, it becomes 240 percentage as your SD. Please apply common sense. Something which is 12%, can it deviate by 240%? Less probable. I mean, it's not impossible, it's less probable. But something which deviates, which is average 12%, can it deviate by under root of 5.8, which means can it deviate by 2.4%? The answer is obviously yes. Which means, sir, the returns have been in decimal, but the variance have been given in obviously directly in percentage square terms. So I have been given the variances, I have been given the beta, I have been given the weights of the security in my portfolio. Really good question. Let's see what this question tries to do. You are required to calculate systematic and unsystematic risk of the companies. Wow, this total variance has to be broken down into systematic and unsystematic. For us, we know there was a rhythm, there was a flow for thinking systematic risk. The formula actually was how much is the risk of the market multiplied by beta of the security. This was the formula. For us, the common sense was, I know this is the risk of the market, and relative to the risk of the market, my security is this many times risky. So risk of the market is this, and relative to market, my security has this, which means my total risk on which is systematic is this much at squared level. Risk of the market is 2.1, which is already squared. Beta is 0.8. So 0.8 will have to be squared. Beta into equal to into 2.1 gives me 1.344 as the systematic risk. So from the total variance, if you deduct systematic from 5.8, when you deduct is 4.456 is unsystematic variance. This is institute's suggested solution. This is not my solution. If I would be at your place, I will also calculate the under root of it, which is a standard deviation, because risk primarily is SD, that we have seen in the questions of study material. So that you know. Sir, similarly for the second company, you can do it. We are not discussing it. Third, what is the portfolio risk? Now, sir, which model for portfolios? Sharpe model or Markowitz model. In the class, we have learned that whenever institute want you to calculate the portfolio risk using Markowitz, then it will give you correlation covariance between the securities. Have we been given any correlation covariance? No, which means it wants us to use Sharpe model, especially because it has made us distribute the total risk of a security into systematic and unsystematic. And we have 4 to 5 or 3 to 4 different question of similar theme, similar thought process in our out scanner, which means institute, and in all those questions it has used Sharpe model. But if you look at the solution, it has used Markowitz model. Having said that, you don't have to worry, even Sharpe is going to give you the same answer as Markowitz. Yes, so let us proceed. People in the class, one thing before I proceed ahead, I just came to recollected it. If you're watching of this video, kindly do subscribe it and like this video so that I can continue to make similar videos which can be of great help to you in the exam. Yes, boss, please. So, coming back, people, systematic risk of the portfolio, systematic variance of portfolio plus unsystematic variance is equal to total. Sir, how do I calculate systematic variance? So, it's like beta of the portfolio multiplied by standard deviation of the market square. Sir, if I have the beta of individual security, what is the beta of the portfolio? 0.8 into 50% M plus and 0.7 into 50% M plus, memory recollect is 0.75 beta of the portfolio multiplied by beta square into 2.1 being the standard deviation of market is, 0.8 in plus 0.7 divided by 2 is 0.75 into equal to into 2.1 is 1.18125 is the systematic risk of the portfolio. 1.181, wait, I'll have to write it somewhere. Systematic risk of the portfolio 1.18125. Although we don't have to take it till 4 decimal point, since the number is small enough, you don't have to take it till 5 digits after the decimal point. Generally it is 2%. However, if the number is small, you can consider it till 3 or 4. I just want to take it till full so that you realize that the answer as per Markowitz will exactly match with the answer as per Sharpe. Sir, what about unsystematic? For unsystematic, we remember the formula was a square plus b square, because 2ab terminology gets cancelled off due to zero correlation, which means unsystematic standard deviation of a security into weight of a security whole square plus unsystematic standard deviation of security into weight of security B whole square. With that thought process, let us calculate. Sir, do I have the weights? Yes, sir, 50-50. Do I have the unsystematic variances which is already at squared level? Yes. Let's do calculate the unsystematic risk. 0.5 into equal to is a square. This is already variance. So into 4.456 M plus. Then 0.5 into equal to into second security 3.771 M plus. Memory recollect is 2.05675. Unsystematic variance of the entire portfolio, which is unsystematic risk, which is variance level 2.05675. The total of the portfolio is plus 1.18125, gives me 3.238 as the total variance of the portfolio. Yes, this is variance which is at squared level of the portfolio. So 3.238 is the variance of the portfolio. What they have done, they have applied the Markowitz model. But sir, we don't have the covariance or correlation between the security. They have applied the logic of covariance as per Sharpe. That my correlation with security A's correlation with market multiplied by security B's correlation with market will give you this correlation between security AB. As per Sharpe, this is the formula of correlation covariance between the two securities, correct? Using this thought process, they have tried to calculate first covariance between TC and PC, right? Correlation between TCPC, and in the Markowitz they have used that correlation to find out the risk of the portfolio using a plus b whole square formula, Markowitz formula. Done. Having said that, you can continue to follow this also, because otherwise I think it become very difficult for you to remember particularly which method to follow. Done. So ICI should ideally give you marks. Third, if the fund allocation is changed to 60-50, advise whether it is preferable or not. I mean, you have to do the same thing again, just that this time the fund allocation should be 60-40, right? And preferable or not, when something is preferable or not depends on the risk and the return at portfolio level. So now you will have the expected return and the risk of two portfolio, one based on 50-50, another based on 60-40. Try to understand both of them. The risk which is higher is a better portfolio, lower risk is a better portfolio, and higher return is a better portfolio. So give your comment on the basis of risk and return. The same thing that we have done for 50-50, you have to do it for 60-40. Average return of the portfolio you already know. Return of first security into its weight, return of second security into its weight. One is 50-50, another is 60-40. You will have the return of the portfolio in both the cases, right? So question second, with that discussion gets done, you have to do the calculation till 3 digits. They have clarified. So please consider 3 digits. Sir, next question is third question. Question nth of the chapter of mutual fund, right? So come on. In 2024, Mr. Raj, investor, made a lump sum investment in equity mutual fund that had an entry load of rupee 0.05 per unit. We have been given the entry load that over and above NAV, we paid a particular price. In rupee terms, it was 0.05. By the end of year, NAV appreciated by 13.6. Whatever NAV paid, that NAV appreciated by 13.6%. Additionally, the fund declared a total capital gain and dividend of rupee 5 per unit, sir. Other than, along with the NAV increase, there was a capital gain and dividend distribution of rupee 5 per unit, which were reinvested at a year-end NAV of rupee 25. Sir, what a line! The dividend and capital gain got reinvested at an year-end NAV of rupee 25 gives you 2-3 information. First, it is a dividend reinvestment plan. Whatever dividend was there got reinvested. Second, the year-end NAV is 25 at which it got reinvested, which means you also have the year-end NAV. As a result, the investor held 15,000 units at the end. We had some units in the start, we don't know. On those units, we earned 5 rupee of dividend and capital gain multiplied by 5. Those dividend and capital gain got reinvested at a NAV of 25. So we got allotted these many units additionally. The closing unit with that was 15,000. Fine. The fund also charged exit load of 1% when you sell within a year. You'll be charged 1% exit load. Investor 20% tax bracket. Inflation during the year 4.5. Fine. Calculate the number of units purchased by Raj at the beginning of the investment. Once again, okay. On day one, when you made the investment, how many units were purchased? Simple common sense. In mutual fund, we have done multiple questions of this side. In fact, if you remember one particular thing, I said whenever there is a formula of whenever there is a question of dividend reinvestment plan, one particular formula which will be of use is that opening units, let's call them N0 plus. On those N0 units, you will receive some amount of dividend or capital gain, let's say 5. This total amount of dividend capital gain gets invested at a particular NAV, this is 25, and that's how the closing is becoming 50,000. With this formula, let's do calculate the opening. When you solve this, it is like 5 divided by 25. 5 divided by 25 plus 1 divide equal to into 15,000 give me 12,500 as the opening number of units. Easy, basic. Sir, next. Calculate the NAV per unit and total investment made by Raj in the beginning of the year. Sir, on that day, on the beginning, NAV per unit, closing NAV has been given. Sir, NAV appreciated by 13.6%. Please apply common sense. Let's the opening NAV is X. So X multiplied by 1 plus 13.6% is closing NAV of 25. So 25 divided by 1.136 give me 22.00. Since you have to take it till 2 digits after the decimal point. So 22.007 as 22.01 is the opening NAV. That's clear. Total investment. So multiplied by 22.01 multiplied by 12,500 unit is 25,125 as the amount of invest. Once again, I think I made a calculation mistake doing it again. Sir, whatever is my opening NAV, On that NAV, when you purchase 12,500 units, it gives you the amount of investment. But one particular thing you have to understand in here is the amount of entry load. Whatever NAV you purchase, you have to additionally pay. So 22.01 plus additionally pay 0.05. So 22.06, 22.01 plus 0.05 multiplied by 12,500 units is 2,75,750 is the amount of investment. Such a easy, basic, at the same time new and tricky question of mutual fund we are doing. Third, appraise the return percentage and the real term percentage. Sir, what is my overall return? And in real terms, what is the return? If Mr. Raj decide to exit the investment at the end of the year, sir, please remember, if you sell within a year, then there is an exit load as well. They are asking you to redeem at the end of the year. I mean, the language is not really clear. If it is redeemed within a year, right? 1 second. They have given us the information regarding. Cool. They have not very clearly specified when was the investment made. But given the information of exit load, we are assuming that when they redeem it at the end of the year, it is like before the completion of 1 year, which means we will apply exit load. We have to calculate the return. For reinvestment plan, what is the formula of return? Really simple. Sir, it is like NAV1 into N1. What is the closing NAV multiplied by the closing number of units minus what was the opening NAV multiplied by opening number of units, again divide by the same amount. Sir, closing NAV we know is 25 multiplied by closing number of unit is 15,000. But will I receive the entire amount when I sell it? No, sir. Only 99% of it I will receive, because there is a exit load as well. Minus what was the opening amount of investment? 275,750, which includes exit load and everything. This is the amount of capital gain as well as the amount of dividend and the amount of NAV appreciation. Everything is included in this return. Yes, this return, when I earn, everyone in the class, I have to pay 20% tax rate. Does examiner say which return you have to calculate, pre-tax, post-tax? No. But when they give you a tax rate of 20%, we have to obviously try to make use of that number and try to calculate the post-tax return, which means only 80% of it is my income. Final income, 20% I have to pay tax, right? So let us do calculate the numerator. So 25 multiplied by 15,000 gives me 375 minus 1% is 371,250 minus 275 750 whole multiplied by 80% divided by amount of investment of 275,750, right? So overall the return which I could earn through this formula is 27.706, which is 27.71%. The thing that you have done in a formula has been represented in the form of a table, right? What is the real return, which means excluding inflation? So you should know this relationship that 1 plus real return into 1 plus inflation is equal to 1 plus nominal return. In the actual world around you, the return actually earned by you is nominal, which means the one that we have calculated as 27.71 is nominal. If I divide 1 plus inflation to it, I will get the real return. So 1 point, how much is the return? 227. 1.2771 divided by 1.0, how much is the inflation number? 45. 1.045 if you divide, and if you press equal, minus 1 give you 22.21% as the real return, which has been there in question number 3. Overall, really good question. Small tricky things. Point to learn is first, make use of exit load and make use of tax rate. First thing. Second, when they say dividend gets reinvested, you have to think of it as a dividend reinvestment plan, which has a standard formula. You know what is that formula? Opening plus dividend reinvested is the closing unit. And other than that, question number 3 is all set. Question number 4 is also a easy, very easy question asked by the institute in September 25 attempt. Right. Sir, ABC Limit share is currently traded at a price of 192.5 per share. This company's share price is 192.5. Mr. Roni is planning to purchase the share. Fine. For this purpose, he has taken services of financial analysts to know whether the price is fairly priced. So we want to know whether this price of 192.5 is fairly priced or not. The analyst has assembled the following information. What is the information? The before tax required rate of ABC debt, preferred and common stock is 8.6, 11 and 13. So before tax the required rate of return of all three security is this. Fine. Company's target capital structure is this, debt, this preferred security, this stock. So fine, we have the individual cost, we have the individual weights, we can have the overall WACC. Fine, so market value of company's debt is 275 and preferred stock value is 120. So we have been given the market value of debt and preferred equity. ABC free cash flow to firm, sir, for a particular year which has just ended, FCFF is 125 and expected to grow at the rate of 8% forever. We have FCFF, we have its growth rate, we have the discounting rate which is WACC. Sir, ultimately now we have to apply FCFF model to find the value of a share. Tax rate 30%, 20 million share. As the financial analyst, value per share, you have to find out whether it is worth to purchase or not. You must be thinking which model to apply. Needless to mention FCFF model. Sir, I have FCFF 0 because it is for the year which got ended. 0 multiplied by 1 plus g divided by WACC minus g, calling it KO minus g. Do I have the FCFF 0 ready with me? Yes, 125. Do I have the growth ready with me? Yes, 8%. What about WACC? If I have the individual cost 8.6, 11 and 13 and individual weights, can I calculate WACC? Correct. But before that, please observe these are before tax required rate. Sir, for KE and preferred equity, there is no tax advantage. They are anyways post-tax. But for cost of debt, which is based on the interest element, for interest we get the advantage of tax, which is why KD can become post-tax. Yes, 8.6 is the cost multiplied by what is the tax rate? 70%, making it KD post-tax. So this K cost of preferred equity and cost of common equity along with the respective weight, when I multiply, I get the WACC as 11%. Now let us solve it. Sir, 125 plus 8% divided by 11 minus 8% is divided by 0.03. So 4500 is the value of firm. 4500 value of firm. From this value of firm, I need to calculate the value per share. What will you obviously do? Deduct value of debt and preferred stock. We know the value of the firm has value of everyone, minus value of debt is how much? Value of debt is 275 minus preferred equity is 120. So 4105 is the total value of equity, which when divided by 20 million number of share, it is 205.25 is the value of equity per share. Do you have to only find the value or also comment whether we should purchase or not? Sir, according to us, fair value is 205 where the price in the market is 192. We call the share to be undervalued and suggest its purchase. Part A gets done. Part B, what it says. People in the class, are you all there? Align to me. Be there in the discussion. Please listen to me. We are to assume we are to get the same value of equity as calculated in part 1. In part 1, you calculated the value of equity. This is totality, this is per unit. Fine. Using FCFE, assume that we are to get the same value of equity as calculated in part 1 using FCFE approach. Calculate the free cash flow to equity for the year just ended if FCFE expected to grow at 8.5. Let's say we get the same value as calculated in part E using FCFE approach, right? In that case, what would my FCFE be, assuming it grows at 8.5, meaning to say this time I have the value. Either you take totality or you take per unit, both are fine. right? For example, 4105. Suppose 4105 is the value of the equity I get, right? That is equal to some FCFE 0 that I don't know multiplied by 1.085 divided by what is the cost of equity. Please remember this time I have to take cost of equity, not the cost of entire debt. So 13%, 0.13 minus 0.085, right? So let's solve it. Sir, 0.13 minus 0.085, right? When that gets multiplied with 1405, right, and 4105, and when that gets divided by 1.085, you get 170.25, 170.25 as the overall FCFE. You must be confused whether you have to take it per unit or totality. So divide by 20 million, you will also get 8.51 as per unit. I mean, I would suggest you to do both. If you are doing totality per unit, multiply it with 20 to get totality. If you are doing totality, divide it by 20 to get per unit. Because examiner is not clear in B part of this question. Really great question, easy one. Question number 4th gets done. No ambiguity at all. Question 5th. Again, let's see what this question from the attempt of September 25 exam paper trying to tell us. Quick and Smart is a leading software development company in UK. Fine. Sir, B there in the Forex. What is the approach that we follow in the class? We say when you have a company in UK, we say the home currency is pound, right? Fine. What's the next thing? It says it has substantial portfolio of its trade in various countries. It has recently invoiced a USA customer. When you invoice someone, basically you are an exporter, right? And what is the foreign currency? The foreign currency is 75 lakh receivable in 1 year's time. So when you receive the foreign currency, what is the next plan? Sir, you sell the foreign currency. When you go to the forex market to sell the foreign currency, what is the next thing? Sir, you get home currency inflow. So the entire mindset is to receive the final home currency, which is pound, by selling 75 lakh dollars in the forex market. Agreed. The background is set ready with us the way we do forex in the class. Quick and Smart CFO is considering two alternatives. One, borrowing present value of USD 75 lakh now in 1 year time. एक second. Borrowing present value of 75 lakh USD now for 1 year, converting the amount into pound and repay the loan out of eventual receipts. Sir, 1 second. This is nothing but if you realize is nothing but the process of money market hedging. Sir, what does money market hedging involve? That you will receive 75 lakh dollars out here. So you borrow present value of 75 lakhs. Why? Because whenever out here, when it comes to repay 75 lakh, when you borrow present value of 75 lakh, you will have to repay 75 lakh dollars. So from the customer, whenever we receive that 75 lakh, as it is, we use that amount to make the repayment of the borrowing. Sir, whatever borrowed today is sold in the market. You get the pound, which is your home currency. At a spot rate you sell it, and that pound you invest today to redeem the pound, the home currency inflow that matters. That is alternative one, which is money market hedging. Since we have discussed this alternative, let's solve it. You are required to calculate the net proceed of pound under both the alternatives. Sir, time is 1 year. Pound rate of interest for 12 months is 5%. So 75 lakh divided by 1.05, present value is 7142857 something, the amount of pound I will borrow today. Let's go to the market to sell it. I have, the amount of dollar I need to borrow today, not pound, the dollar I need to borrow today. The rate of pound has been given. So I need to divide to find out by when I borrow an amount of 714285, which is there on my calci. When I sell this amount, how many pounds will I receive? Divided by 1.3288 gives me 537.5419, the amount of pound I will receive today. Let's invest this amount at a rate of 4.5. Kindly pardon me, I will have to restart the thing because I have unfortunately taken a rate of pound on the cash flow of 75 lakh dollar. I misread the question. Let me start it again. We know 75 lakh dollars I'll receive here, so I have to borrow the present value. Borrow the present value of 75 lakh dollar. When the rate of dollar is 4.5 for 1 year, so 75 lakh divided by 1.045 give me the present value, right? Whatever amount of dollar I have borrowed today, I will go to the market to sell it. Rate is of pound, which is why I have to divide it by 1.3288. Give me the amount of pound my home currency I'll receive as 540,1138. Let me invest that amount for a year at the rate of 5%. So multiplied by 1.05 give me 567,1195. 567,1195, something on a rounded off basis as the amount of final home currency inflow. However, if you use forward rate, you have to simply divide 75 with this given 12-month forward exchange rate, and you will automatically know the amount of receipt. Since it is about the inflow, higher is better. As you observe, forward seems to be a higher, and that is better alternative to question 5th similarly gets done. I hope all of you are able to connect it to whatever has been discussed. People, set are we all there? So we have completed September 25 exam paper. Now we go back to September 25 MTP. Question 6th is an MCQ. Question 7th is a really easy question. Let's go through it. On 1st April 15, Sunidhi was holding a portfolio of 10 securities whose value was 994,450. The weighted average beta of 9 securities 1.1. Out of those 10 security, the beta of 9 security was 1.1, and beta of the last security we don't know. Fine. Since she was expecting fall in the price of the share, to hedge the portfolio, she sold 5 contract of Nifty future. Please go to derivative and figure out which topic of the derivative it is. It is hedging your portfolio using index futures. Fine. So she sold 5 contract of index futures at a price of 8767 on 1st April, right, having 25 multiplier. So on 1st April you sold it, where somewhere in the May the contract will expire. Today you stand on 1st April only. Fine. What is the beta of 10th security? Sir, what kind of question this is? Beta of 10th security. As I told you, whenever you have the question of reverse calculation, what do you have to do? In the reverse calculation question, you have to, people in the class, simply put the formula of what is there. The beta of 9 securities I have, fine, but I need 10th. Okay, no formula here. I have been given the contracts being sold, the number of contract formula. What is the formula? That's the value of the portfolio into beta target minus beta of the portfolio divided by price of the future multiplier. Multiplier give me the contracts. Since it is 5 contracts sold, I have to take a number of -5 here. As we do it in the class, the position is short, the sign is negative. Mathematically, the position is long, the sign is positive. Yes. So boss, -5 is there. What is the value of the portfolio? 994. 450 is the value of the portfolio. Beta target would have been 0 in the absence of information. Beta portfolio, we don't know. The entire beta of 10 securities, we don't know. We have the beta of only 9 securities. Fine. Price per future is 8767.07, multiplier is 25. When you try to solve this equation, you get the value of portfolio. You get the beta of the portfolio as something. All the information, when you put the beta of portfolio is 1.102, which is the weighted average beta of 10 securities, right? So sir, if I have the weighted average beta of 10 security, that is beta of 9 security into the weight of 9 security plus beta of 10th security into beta of weight of 10th security. Sir, beta of 9 securities, the already weighted average beta of 9 is 1.1. The beta of 10th security we will find out. And I know the weighted average beta is 1.102 as already calculated. Sir, if I somehow get the weights, then I'll be able to calculate the beta of 10 security, which is what the examiner asked. The ambiguity of this question is that examiner is silent about the weights, and in the absence of information, we have assumed them to be equally weighted. So let's assume 90 securities 90% and 10 securities 10%, and that's how you back calculate the beta of 10th security. These are some, see, I accept that it's not your problem, that how do I solve, like it's not your mistake, fault when you get an ambiguous question. Despite that, if you really want to win it in the exam, try to have the best possible assumption. What is the best possible assumption? Equal weighted. That in some other questions of portfolio also we have done, not just this particular question. So beta of 10th security we have. Second part is theory. I would request you all to read that question and answer at your own. Question 7th gets done. Question 8th. Let's see what this question people in the class try to say. SS company is considering the replacement of its existing machine with a new machine. Fine, the company is considering replacement. The purchase price of new machine is 27 lakhs and its expected life is 8 years. So 1. It is a question of replacement that you have learnt in advanced capital budgeting decision, where new is to be replaced, new will replace the old. Purchase price of new 26, expected life 8 years. Company follow SLM. Original investment will be used for depreciation, no salvage value. Other expense, installation 9,000, fees paid to figure out which machine to buy is 6,000 rupee. Additional working capital 17,000 which will be released at the end. Fine. So with respect to the new machine, we have been given all the information. Written down value of existing machine is 76,000. Cash salvage value is 12,500. Dismantling of this machine would cost 4,500. So now the information of old machine. 76 is the book value in my books. When you sell it, you receive 12,500, but you have to pay 4,500 for dismantling. So net you receive 8,000. The annual earnings before tax but after depreciation PBT of new machine would be 315. Income tax rate 35%, required rate of return 30%. We have been given the present value. Try to think replacement. How have we learned in the class replacement? Sir, alternative 1 is continue the old. Alternative 2 is sell the old, buy the new and then do the business. Sell the old, buy the new and then do the business. If I continue the old, sir, what will, in fact, if you realize, let me tell you, hold on for a minute, let me try to simplify it for you. Give me a minute. Okay, let's proceed. Let me solve it and then I will give you the conclusion. If I continue the old, is there an additional cost I have to incur? Any cost I have to additionally incur if I continue the old? No, sir. The machine is already there. It already has the book value. It has everything. I don't have to do anything to do the business if I continue the old. So to continue the old, what is my initial cost? 0. However, alternative 2 was selling the old and buying the new machine. When I do this entire thing, what are the inflows and outflows? Let's think. Sir, when I sell the old one, machine is sold for 12,500, but 4,500 is the dismantling cost. So net I receive is 8,000. Second, tax benefit. 76 is the book value. When something which is of 76 is sold for 8,000 net, it gives you a loss of 68. On a loss of 68 at the rate of 35%, which is 23,800 is the tax advantage you will get. So 8,000 is the net selling price plus 23,800 is the tax advantage. So 31,800 people in the class is the 31,800 is the final value I will receive when I sell the old. What about the cost of buying the new, right? Sir, 26 lakhs plus 6 plus 9 plus 17 as my working capital. So 38 is already M plus 26 plus 26 lakhs, which is in terms of 1000 is 2600, plus 9 plus 17 plus 6. Wait. Give me 50 to 58 as my investment, and net amount of investment is, where is the net amount of investment? I have to tell you. So give me a minute. We came up, let me show you the individual amount: 26 lakhs, 9,000, 6,000 and 17,000. All these are my initial investment. The benefit that you get is 8,000 and 23,800 tax benefit. So from all these outflows, let's deduct these two inflow. So 26 lakhs plus 6,000 plus 9,000 plus 17,000 minus 8,000 minus 23,800, give me 26,002,000 on my calci as the initial outflow. You don't have to compulsorily follow this presentation. The way we did our presentation in the class, you may follow that. So option 1, initial outflow 0. Alternative 2, initial outflow 26,002,000. So what is incremental outflow in option 2? Sir, here outflow was 0. Here it is 26,002,000. So the entire amount is incremental only. Fine, sir, sorted. Next. Sir, next. What are my annual inflows? Alternative 1, continue to use the old machine. There is no inflow we have been given. Alternative 2, use the new machine. We have been given the PBT as 315. So in this amount of PBT, which is after depreciation, but before tax, let's deduct 35% tax. So it is 204,750 as the amount after PAT. Right, as the amount of PAT. To this PAT, if I add back depreciation, sir, how much will be depreciation? 25 lakh plus 9,000 plus 6,000. So 25 lakhs, right? 25 lakhs plus 6,000 plus 9,000. Don't add working capital. We are talking about depreciation. Divided by the life of how many years? Have we been given the life of 8 years? Divided by 8. Give me 314,375 as the amount of debt. When you add to the amount of PAT, it is 519,125. Something is wrong. 326,875, I think the amount was correct. So 3,15,000 minus 35% tax plus 326,875 as the amount of debt is 531,625 is the amount of CFAT. It is what actually? CFAT. Alternative 1, no CFAT. Alternative 2, this CFAT. So can I say entire amount is an incremental CFAT? Because in replacement we talk about incremental. Done, sir? Great. Sir, I hope this is clear. This is your PBT minus tax is PAT plus depreciation is CFAT. The way we learn it in the class is this terminology. Fine. Sir, next, terminal. Here there is no working capital that they have talked about in the existing case. But in the new case, working capital of 17 was invested, which gets released at the end of 8th year. So 17 got released. Incremental release is 17 only. Overall incremental NPV. Initial cost 26,002,000. Every year incremental inflow. 531,625. At the end of 8th year, incremental inflow of working capital 17,000. Initial outflow, every year inflow, terminal inflow. When you have all that, the NPV calculation become easy. Since the NPV is negative, the project is not viable. Question number 8. With that, people in the class gets done. Yes, 8th is done. 9th from September 25 RTP. So we are also done with September 25's MTP. 9th is MCQ. So in September 25 RTP, no question. May 25 exam paper. Question 10th is MCQ, 11th is MCQ, 12th is MCQ, 13th is MCQ. 14th question, May 25. Let's do. May 25 exam paper, is it? Exam paper May 25. Come on. May 25 exam paper. Question 14. What it says? BC Limited is contemplating on buying a new machine at 70 lakhs with additional working capital requirement of rupees 10 lakhs. Sir, what it says? There's this company who's contemplating to buy a new machine at 70 lakhs with additional working capital requirement of 10 lakh. So I need to invest 70 lakhs in a new machine, additional working capital of 10 lakhs required. Machine expected to have life of 5 years, no salvage value, fine. Company flow, SLM method, it and it's there for tax purpose as well. Machine is expected to generate incremental increase in before tax cash operating income. Sir, before tax obviously, matlab before tax EBIT. Operating income is EBIT, but cash operating income is EBITDA. Operating income, which is cash, which means depreciation has not yet been deducted, is EBITDA. So 25 lakh is the EBITDA per year for period of 5 years. Sir, in real terms, what it says, the actual EBITDA for the next 5 years in respective year will be different. That will be with the effect of inflation. But without the effect of inflation, the actual, the real is 25 lakhs. Fine. Assuming tax rate 35%, inflation 6%, cost of capital in real terms 10%. Sir, please remember, to discount real cash flow, you need the real discounting rate. To discount nominal cash flow, you need nominal discounting rate. If the cash flow is real and the rate is also real, we are fine with it. Assuming that working capital will remain unchanged in spite of inflation. Listen to it carefully. They say today when you invest 10 lakh, then after 8 years, what is the life? After 5 years, the same 10 lakhs continue to remain invested. Don't assume that with inflation, the amount of 10 lakhs will increase. The same 10 lakhs continue to remain invested. Advise whether it should purchase or not. Calculate NPV in real terms. In real terms means continue to remain, let the cash flow remain real only. Let the rate remain real only and then calculate NPV. For NPV, if I have EBITDA, right? From the EBITDA, if I deduct depreciation, I get EBIT, right? For example, let's say I have EBITDA of 100. From that, let me deduct depreciation of 50. So I get EBIT of 50, which is my PBT. In capital budgeting, we don't talk about financing cost, which is interest. This is my PBT only. From PBT, let's say the tax rate is 30%. So 15 rupees, 30%, which is 30%, which is 15 rupee of cost gets deducted. So PAT is 35. And to the PAT of 35, when I add back depreciation, which is 50 rupee, I get CF80 of how much? 85. Agreed, sir. Similarly, I have been given the 25 lakhs rupees EBITDA, which is in real terms. The actual EBITDA will be different, but at today's inflation level, EBITDA is this. Similarly, do I have the depreciation of every year in real terms? Sir, 70 lakhs divided by 5 give me 14 lakhs of depreciation every year. But please observe, today it is 14. For the next 5 years, it will continue to remain 14. The actual depreciation of next 5 years in nominal terms is 14. It is not real terms 14. Sir, how do you know? Do you remember I said nominal is the actual that happens in that year? In the next year, will the revenue be 25? Will the EBITDA be 25? No. Today it is 25. Next year it will be more in actual terms, in nominal terms. Which is why 25 is real. Because actual will be more. But if you realize the actual depreciation won't be more, it will be 14 only. The nominal of next 5 years is 14, which means, sir, from the EBITDA we need to deduct the real depreciation, not the nominal, so that we can continue to do the real solution, real cash flow based NPV calculation, right? Which is why we have found out a shortcut. One option is to find the real depreciation. Sir, we have done it. We have done it. For example, 14 lakhs is the amount of depreciation. How much is it? 14, right? So 14 multiplied by, if you observe, at the rate of 6%, we have been given the present value factors. Please observe what will these factors do. Will they bring the depreciation of coming years to present value? Will they bring the depreciation of coming years to the present value? No, they will only eliminate the inflation component, and at the end of respective year, it will continue to remain just that it will be real. It won't do the present value. It will continue to remain at respective year end, just that it will be the real depreciation that we can do. Alternative 2 is, sir, let's simplify the solution. Ultimately, I deduct a depreciation, I add it back. Then why do you deduct it? For the purpose of tax advantage. So why don't you take the tax advantage directly? Meaning to say, if it is 100 rupee of EBITDA, why don't you deduct 30% tax out of it directly, right? So 100, sorry, what was the tax rate? 30%, right? So 100 minus 30% give me 70 directly after tax expense. But this depreciation benefit has not yet been received, because rather than paying tax on 50, I have paid the tax on entire 100. Don't worry. On the amount of depreciation of 50 rupees, on the amount of depreciation amount of 50 rupees, you take 30% tax advantage. Sorry, in our example, the tax rate was 30%, right? 30%. So you take 30% tax advantage and add the benefit separately. So depreciation is 50, 30% of which is 15. If I add 15% separately as the amount of tax advantage on depreciation, it becomes 85, which means there are two ways to calculate the CFAT. One is directly adding the advantage, because initially we didn't take the advantage on the EBITDA directly, we multiplied tax rate. So let's apply the same thing. Why? Because so that since 25 is the amount of EBITDA of every year, we don't have to do the separate calculation for every year, because we have eliminated the depreciation to the end. So this particular part will continue to remain common for the next 5 years. Are you understanding? We can create annuity. For example, we say 25 lakh is the EBITDA minus tax rate directly, 25 lakhs real EBITDA minus 35% will be real CFAT, in which the depreciation is yet to be added. I know that. I will add it separately, because this part is same for the next 5 years. I can directly multiply the annuity factor. This is real cash flow. Real rate is 10%. So real annuity factor is 3.79. When I do it, present value of cash flow in real terms is 6158750. I know that for the next 5 years, whatever are the amount of depreciation in real terms, on that 35% will the tax advantage, present value of those tax advantages is to be added to this benefit, right? Sir, 14 lakhs amount of depreciation every year multiplied by 30%, multiplied by 35% is 4.9 lakhs, the nominal depreciation of every year. So for the year 1, 2, 3, 4, 5, normal dep is this. If I multiply the present value factor of inflation rate, I get the value of depreciation today in real terms. In those amounts of 4.9 lakhs of every year, the inflation effect is already there. Let me eliminate the effect of inflation and bring them to present inflation. I mean the present inflation level. The cash flow continue to remain at the end of year 1, 2, 3, 5 only. The effect of inflation we are eliminating. So factor at the rate of 6% are this. So these are the real tax savings of respective year end. When I do now multiply the present value factor at a real rate, this is the actual present value. This is actually bringing the cash flow from year 1, 2, 3, 4, 5 to the present value. The benefits, the real benefit for the next 5 years are this, and present value of those benefit is this. Sir, ultimately, because we wanted to make this table really small, we did this part separately, because for the next 5 years I have same cash flow, but this part we created a separate table because every year we had a different depreciation amount in real terms. Agreed. Now the final NPV. What do we say? We say, sir, initial outflow is 70 plus 1080. 70 plus 1080 is the initial outflow. Fine. Sir, every year I have present value of future cash inflow this, and along with that I have the present value of depreciation as this. So 6158 and 1581. Fine. Along with that, sir, one more thing to learn. I invested 10 lakh rupee of working capital today. The same 10 lakhs will get released after 5 years. Now actual amount after 5 years 10 lakh, that is the nominal cash flow of that point, because that is actual, right? Sir, first you have to convert that working capital of 10 lakhs based on today's inflation, make it real, which means eliminate the effect of inflation using 6% for 5 years. Once you have the real cash flow, then you discount it using 10% for 5 years. So sir, whatever is the amount of cash flow, first you multiply at the rate of 6% factor, then you multiply at the rate of 10% factor. This one is converting to real, this one is bringing to present value, making it 463,887. This is the terminal inflow. Initial outflow, annual inflow and terminal inflow, finally is NPV, which is positive, which is why you say you should accept the project in question number 14. Boss, I hope I am able to convey this entire story to you. Just give me a minute, please. Just give me a minute. Okay, boss. Are you all there? So, just 1 second. Just 1 second. So, fine. I think it is all set. So, 14th question, people, gets done. 15th is extremely easy question. It is so easy that we are not discussing it in the class. 15th is extremely easy, right? It is like, so let me solve 1 or 2 parts of it. You will get what it is. DF has implemented a strategy to manage interest rate risk, right? By taking cap and floor. Cap, option to borrow, floor, option to lend. The company purchased, really important, purchase means you have the long position, you have the option, you have a decision to exercise on a notional principal of 50 million of cap of 8% at a premium of 7.75 of the face value to protect against rising interest rate. In simple word, we have the option, because it's purchased, to borrow an amount of rupee 50 lakhs at a rate of 8%. Fine, for which you have paid a premium of 0.75%. Similarly, there is a put option in the market on which, as of now, question has not specified what position have you taken. Here they said purchased, like $50 lakh floor is also available in the market, that is not purchased. Fine, you are required to analyze. B part seems to be more comprehensive. Let's do it, because A part talks only about cap, B talks about both cap and floor. If DF also purchase floor along with the cap, what is the net saving? Think common sense. Net saving is gross payoff minus premium on both of this cap and floor. Rate in the market is 10. I have an option to borrow at the rate of 8%. Will I exercise? Yes. How much is the advantage? 2% of 50 lakhs. Sir, how much is the time period? Have they anywhere specified? If no, we'll assume the time period to be 1 year. I don't see any time period, whether it is 3 months or what, right? So 50 lakhs multiplied by 2% is 10 lakhs being the advantage, right? 1 lakh being the advantage. Now about the premium. 0.75 being the premium on 50 lakh. So 50 lakhs into 0.75%. 50 lakhs multiplied by 0.75% is 37,500 being the premium of cap and 42,500 being the premium of put, total premium being 80,000. So from 1 lakh, when I deduct 80, what I'm left with is just 20,000 of net savings I will have of net, like of both the positions, cap and floor. That way, question number 15 is an extremely easy question of simply calculating the net payoff from on the settlement date. Fine. In the attempt of May 25 MTP, question 16th is MCQ, 17th is fine, 18th again is MCQ, question 19th is MCQ. Okay, in May 25 RTP, question number 20 is there, which is a practical question, an extremely easy question, right? Let's see what it tries to say. ABC, large business house planning to sell subsidiary KLM. Fine. Another large XYZ wants to buy KLM. I am ABC, I want to sell this division. Another company wants to buy this division. It is expected that annual earning of KLM will increase by 10% after acquisition. So after acquisition, the increase in the earnings will be 10%. This is about the synergy advantage. Fine, sir. Following information, ignoring any potential synergetic benefit are available. Profit for the financial year just ended 10 crore for KLM. The division that we are talking about, the subsidiary that we are talking about, has 10 crores of profit. It has increasing trend of 7% each year. It will continue to grow by 7%. Sir, what was this 10% then? It was a one-time growth on account of synergy. That increased profit will continue to grow at the rate of 7% every year. Post-tax return, market return 10%, RF 4%, it will continue tax rate 30. XYZ, the company who wants to buy KLM, ABC, the existing owner of KLM, and proxy entity of KLM in same business. So KLM is a different subsidiary. In the market, there is one more company who has same business as KLM, number of share given, price per share given, dividend payout given, debt to equity at market value. The ratio is 1:2, 1:3, and 1:4. Fine. P ratio of respective company given, equity beta given. Assuming gearing level of KLM is same as ABC. My division KLM, right? What is the debt equity ratio of this division? Is same as ABC, which is 1:3. Fine. Debt beta 0. You are required to calculate cost of equity of KLM based on available data. When you talk about cost of equity, what comes to your mind is RMRF, which is CAPM. For that, you need the beta of KLM. Have we been given the beta of KLM? No, we have been given the beta of proxy entity. So using the data of proxy entity, can I calculate the beta of my company? Yes. Sir, for the other company, there is this equity beta given. Using the debt, I can find out the firm's beta, which will be the asset beta of that another company. The same will be the asset beta of my company. Using the asset beta of my company, I'll be able to back calculate the beta of equity of my company because I also have debt. Sir, that proxy entity whose beta has been given as 1.1 has debt equity ratio of 1:4. If 1 is equity, 1:4 debt to equity, sorry. If the debt is 1, equity is 4. Using the weighted average, can I find the beta of asset of the proxy company? Yes, let's do the weighted average. Remember one thing, when we do the weighted average, if the tax rate is given, then whenever you have D, we take the D as 1 minus T. What is the formula of weighted average? Really simple. Beta of equity into the weight of equity. Beta of debt into the weight of debt is weighted average beta, the asset beta. Beta of equity is 1.1 of the proxy company I'm talking about. What is the weight of equity? Sir, if the ratio is 1:4, means weight of equity is 4 divided by 4 plus 1, where with the debt you will have to multiply 1 minus T, which is 0.7. Beta of debt is 0. Entire terminology becomes 0. This weighted average is equal to the asset beta, which means this equation when I solve, I get the asset beta of 0.94. You can solve it. 4 divided by 4.7 into 1.1 is 0.936. Do we have to take it till 2? Yes, otherwise beta is always 3. Otherwise I would have done it 0.936. Fine. If I have the asset beta of this company, same continue to remain the asset beta of KLM. So now let's reverse calculate the beta of equity of KLM based on the weights of KLM. What are the weights of KLM? 1:3 are the weights of KLM. So let's now calculate it. Sir, 0.94 is the asset beta of KLM, which is nothing but the average of equity and debt. Beta of equity into weight of equity plus beta of debt into weight of debt, which has all become 0 because beta of debt is 0. Beta of equity into the weight of equity. Sir, 1:3 is the debt is to equity ratio, right? As they said, KLM leverage is same as ABC. So ABC leverage is same for KLM. Sir, 1:3. So 3 is the equity divided by 3 plus 1, where 1 will be multiplied with 1 minus T. When you solve this entirety, beta of equity turns out to be 1.16, which is part to the first part of this question. Right? Just give me a minute. Yes, people. So cost of equity we can calculate once we have beta of equity. For my entity KLM, 1.16 is the beta of equity, RM is 10, RF is 4. So 1.16 into RM minus RF is 6 plus 4 give me 10.96 as the cost of equity. Easy, basic, done. Sir, B, range of, so this question although is basic, now onwards it is basic, but has variations in the solution. They talk about the range of values for KLM before and after synergy benefit for 2xyz of the acquisition, benefits to xyz of the acquisition. Fine. Sir, I need to give not a value but the range of values, right? I mean, using different thought process, what can be the value of the company. Now, when I give the range of values, I have to give it before and after synergy benefit. This 10% benefit was there. Right. Now, what are the possible ways to do the valuation? Sir, we have been given PE ratio. Can we do the relative valuation? Yes, possibility one. Sir, we have also been given the payout ratio. We have also been given the growth rate. We have also been given the cost of equity. Can we apply dividend valuation model? Yes. These are the two models we have to apply for both the cases, without synergy benefit, with synergy benefit. Yes, so let's see. When you apply PE model, now in the PE also there are two possibilities: PE ratio of proxy entity or the PE ratio of XYZ being the acquirer company, right? This is a point of ambiguity. Ideally, there would have been two things: PE of ABC, the present owner, and PE of XY. It should not at all be proxy companies PE, because PE also gets affected by the capital structure, which is different for the proxy company. Although this level of detailing I have never taught you, an institute is not expected to apply that level of concepts, but PE gets affected due to capital structure, right? Having said that, institute has compared, I mean, does the calculation keeping in mind the PE of these two things. Sir, my present profit 10 crore. Fine, sir, 10 crore present profit. Without synergy benefit, it will continue to remain. What is my PE? What is the buyer's PE? 10 times. And what is the present PE of KLM? 12. So 12 into 10 crore and 10 into 10 crore are two possible value. Sir, with the synergy benefit, 10 crore present profit multiplied by 10% growth rate, once with my proxy company's PE, once with the buyer's PE. Again, the two possible values. Sir, dividend valuation model. Whatever is the amount of profit, right? That is P0, profit P0, right? Which is the year just ended profit has been given. Earnings 0 has been given. So 10 crore is the earning of 0 year. Sir, multiplying a payout. Now two possibilities of payout. Payout of proxy entity and payout of the buyer of KLM, the new company. If 40% is paid out and then 50% and paid out, both the possibility. If you pay 50% and if you pay 40%, I get the amount of dividend. This is earning into payout ratio is the amount of dividend of 0 year. Multiplying the growth. Which growth? The Gordon's model growth, to make it the dividend of first year, not the synergy benefit. To make it the growth of growth, to make it the dividend of first year, this is the growth, divided by KE minus G. Sir, KE, you will obviously take the factor that you have calculated for particularly KLM, minus G will be the value. To the same story, if there is synergy benefit, we will also multiply 1.1, because with the effect of synergy, dividend will be 10% more, whether it is 50% payout or 40% payout. Of respective payouts, it will be 10% more, multiplying 1.1 to it, rest of it remain the same, you get two possible more values. So 4 values here, 4 values here. Sir, how do we get to know that? We have to do possible things, even I cannot know. This is something along with understanding you will have to remember. You have to remember that there are 4 possibilities each. Individual possibility has a logic, but remembrance require 4 possibility. Third part. Sir, compute market value of KLM as a part of ABC. Again, open-ended question. ABC's entire value is 80 lakhs into 375. 80 lakhs into 375, which is 30,000. ABC's total value is 30,000 lakhs, which is 300 crore. Now, sir, how do I find out KLM's value in ABC? Because they never say that of the total value of ABC, KLM is 50%, 15%, 10%, nothing. Sir, we have tried to do the proportionate using profit. That if their share price is 375, if their P ratio is 13, so 375 divided by 13 give me their profit. 375 divided by 13 give me their profit, multiplied by 80 lakh shares give me their total profit of 2307.69. 2307.69 lakhs the total profit of ABC. In that total profit, the profit of KLM has been given how much? Sir, 10 crores. 10 crore is 1000 lakhs. So 10 crore out of 23.0769 crore, either you take lakhs or crores. This is the proportion of profit of KLM in the total profit. So accordingly, in the total value of 300 crores, what will be the proportion of KLM? That you calculate proportionate, it will be 129.98 crore with this thought process. Sir, how can one know this will be the thought process? I agree to you, this one can never know that this can be the thought process. Still, you will have to kind of remember the solution of question 20. May 25 RTP, we are done. November 24 exam paper, we are there. A lot of new question institute asked. Sir, let's start with question 24. So easy, although it is new, but so easy that only you should also do it only on the calculator. We are not discussing it in the class. Extremely easy. 25th, unfortunately I have brought it here, is not even a new question. 26th is really a new and extremely ambiguous question. Let's talk about question number 26. PQ Limited expects sale to be 100 lakhs in year 1. Fine. The same will increase by 20 lakhs over the next 4 years. So we have the sale of next 5 years. At the end of 5th year, project will be wound up. Depreciation will be charged 20% on a straight line basis. There is a project whose first sale is 100, first year sale is 100. So second, third, fourth, fifth year sale is 120, 140 and so on. So these are the sales of next 5 years. Depreciation, we don't know the original amount of investment, but will be 20%. Fine. Basically 5 divided by 5, done. Expense other than depreciation is 40% of sale. If respective sale is this, expenses excluding dep is this. Fine. There will be no salvage value. Fine. PQ proposes to invest where the NPV is 0. We want to invest in a project such an amount that NPV is 0, meaning to say present value of inflow. When is NPV 0? When the present value of inflow minus the present value of outflow is equal to 0. So I propose to invest such an amount today that NPV becomes 0. Fine. Tax rate 30%, calculate the amount of investment that can be made. First ambiguity, entire question it does not talk about. In the entire question, there is no discount rate given. It is the attempt of November 24 when the institute asks this question to you. Examiner says you can assume any rate that you want. But I have my problems that a student will end up wasting some time to figure out where is he missing, where actually he is not missing anywhere, which is what institute never realizes. So what do? Be smart, use your wisdom. Whenever you think that, okay, I have applied all my brains and I feel the data is missing, assume something and solve it. Or maybe don't assuming it and continue to solve, but don't leave the question is my point. They won't allot you marks otherwise. Correct? So anyways, sir, present value of inflow I need. Sir, if I have revenue, so I need to calculate CFAT. Revenue minus expense minus depreciation minus tax will give you PAT plus depreciation will give you CFAT. Sir, can we apply the same logic? From the EBITDA, why don't I deduct tax and add back depreciation separately? If I have the revenue given to me, if I have the expense given to me, so of the net number which is my EBITDA, of the net number, why don't you directly do 1 minus T? And after that, I add depreciation's tax benefit separately. I know the amount of depreciation, whatever it is, multiplied by a particular tax percentage, I will add separately, as we did in one of the previous questions today, right? So what do? Sir, 100 minus 40 is 60. This 60 after 30% tax rate. So 60 multiplied by 70% give me 42 rupee of this component. This is 42 rupee of this component. Sir, if my initial investment is I, or say P, because book has assumed P. If the initial investment is P, then can I say with 20% depreciation, the amount of depreciation is 0.2P, 0.20P. Of this depreciation amount, I want to take 30% tax advantage. So 0.2 multiplied by 30% tax advantage is 0.0p, 0.06p as the amount of tax advantage on depreciation I want to add to CFAT. Rather than following this scheme, follow this one, easy. Sir, what you have to simply do? You have to simply add, you have to first calculate sales minus expense, right? Yeah, you don't have to create this table in that case. Sales, expense, third table is EBITDA. Next column EBITDA, next column is EBITDA into 1 minus T. Then next column is depreciation multiplied by tax rate, and next column is CFAT, which is EBITDA into 1 minus T plus depreciation into T. So you will finally get this. One or two columns you can save, right? When you do this, you get the, now this is my CFAT. Ideally, when the examiner give discounting rate, these CFATs were supposed to be discounted and then the present value of cash inflow to be calculated, which should be equal to outflow. Or we can say present value of inflow minus present value of outflow is equal to 0, which is why I said 1 is equal to the 2. Both the inflow is equal to outflow. In our case, discounting rate not been given. I mean, these are only the present value of future cash inflow. Can I say when the present value of future cash outflow is equal to inflow, NPV is 0. Outflow is P that I assumed. Inflow's present value is this with the effect of depreciation and everything. Inflow present value is this. And inflow is equal to outflow will give the amount of P, the amount of investment as 420, which is the question 26 about, which is what they have tried to ask us. Are you all please able to connect? How is the simple question of NPV has reverse calculation? Everything is logical except that the rate is missing. Yes, 26th then is 27th. Again a brilliant but easy question from interest rate risk management. I will explain. So come on everyone. XY planning to expand operation in the view of growing demand of its product. Fine. For this purpose, it's considering to borrow 10 crore for 3 months in coming 6 months. So after 6 months, for a period of 3 months, I will borrow 100 crores. Current rate 8%, due to inflation it may go up. Company wants to hedge. At present the rate is 8, but if it goes up, I'll be at loss. I want to hedge. Fine. The banker's quotation is 8.2 per annum for FRA. FRA, which FRA? Sir, ideally it should be 6 by 9 because after 6 months, for 6 months should be 6 by 9 FRA, 8.2. You are required to calculate the actual interest rate if the banker pay amount this to the XYZ. Sir, actual interest rate, which means after 6 months, for a period of 3 months, what in the spot market reference rate turns out to be, the actual rate turns out to be in the market, because of which the settlement when we did for FRA, I got 978, 952.52 as an amount. Sir, really a great question. Sir, if I have been given the settlement amount, can I not back calculate the spot reference rate? Yes, apply the formula. Only point of catch is, sir, I am a borrower. As a borrower, I entered into a contract. Apply. What position will you take in FRA? Long. As per golden rule, do in derivatives the same thing that you will do in the spot market on a later date. Correct? Today, since in the spot market I want to borrow on a future date, on a later date I want to borrow. Today in the derivative, I will enter into a contract to borrow. Right? You enter into a contract to borrow at the rate of 8.2. What do you think in the market rate would be if you received as XY Limited from the bank this particular amount? Rate in the market would be more or less. I mean more or less. Rate in the market would be more. And I had an option to borrow at 8.2, which is less, which is why I received this amount. Correct? So first of all, write this amount positive because it is a gain. And to create this gainful situation, I know the rate in the market is more. So I will in my formula write notional principal into reference rate minus forward rate. Sir, why? Only when the reference rate is more, then only I will have the gain. And since I have taken a positive number here, which is why I should in the formula create a positive situation which will be RR minus FR. If you by mistake do FR minus RR, then this RHS will be negative, where LHS you have taken positive, the answer will be incorrect. Both you have to take positive for gain and both you have to take negative for loss. Yes, RR minus FR. So on the notional principle of how much amount? 100 crores. There would be some reference rate minus a forward rate for a period of 3 by 12 months is the amount of gain loss. But when you discount it, 1 plus whatever is the reference rate again for a period of 3 by 12, give me the present value of this. Sir, let's try to solve it. How would one solve it on the calci? Very easy. Sir, let's bring this value here and let's bring this value here. Divide 10 crore with this value and then let us try to simplify it. Right? For example, sir, so the simplified version will be 1 plus 0.25 RR is equal to, sir, 100 crores divided by 978,952.52 multiplied by, so basically I have taken this number here, I have divided it and also multiplying it by 3 divided by 12 is 255, right? 255.375. This is equal to this into RR minus forward rate of 0.082. This becomes the simplified equation. When you solve this equation, you should get the number of reference rate, right? Let me retry the calculation. 100 crores divided by 978,952.52, right? Multiplied by 3 divided by 12. 255.375 is the number after solving this and this and this. So multiplied by RR minus this, when you solve the simple equation now, you will get the reference rate as 8.6. I have also guided you how do you solve the particular thing. Now this is the answer to first part. In the second part, they say what is the actual interest rate. If XY pay to the banker, this time XY is paying, which means when you enter into a contract to borrow, you have a loss, you have to take it as a negative number first of all. You have entered into a contract and you have a loss. Sir, when do you have a loss? Sir, I entered into a contract to borrow at 8.2 and the rate in the market turns out to be higher. Sorry, rate in the market turns out to be lower. So you say rate in the market is 7, but you will have to compulsorily borrow at 8.2. Then only it is a loss for you. So when you take it a negative sign here, in the RHS, you have to create a loss-like situation. When is it a loss? When you do reference rate minus the spot rate. Reference rate will be somehow, the spot reference rate will be somehow lower and the forward rate will be higher. Rate at which I have entered into a contract to borrow is higher. The rate in the market is lower, then only it is a loss to me, right? And to create a negative situation, RR minus FR is what you will have to do. So the formula, when you apply the same, taking a negative sign here, the answer when you solve it will be 7.8%. Yes, first one I have guided you how to solve. The second one you can do it at your own. Question number 27, people in the class, gets discussed. The main point was not to explain the math. The main logic is to explain the concept hidden in the question. Boss, 28th, really a great question. We can do it in the class right now. Come on, be here. Economic value added is 31,10,000. Following is the capital structure at the end of current financial year. Equity, share capital, reserves and surplus 170 lakhs, debt at the rate of 10% coupon 80, total invested is 250. Beta of ABC 0.9, risk-free rate 8%, average risk premium 10%, economic value added is 31,10,000. Economic value added has been given to me and they have asked me to reverse calculate the profit after tax of the company. Sir, in the entire formula of economic value added, do we have anything related to profit? Yes, sir, we have EBIT, because EBIT into 1 minus T whole multiplied by capital employed into WACC is the formula of economic value added. EVA is given EBIT we can calculate, tax rate has been given, capital employed given, WACC we can somehow calculate. Once you have the EBITDA, you can have the PAT. Let's take it one by one. EBITDA 31 lakh 10,000 given, capital employed 250 given. Let's think about the WACC. Sir, beta is given, RM given, market risk premium, RF given. So 10 into 0.9, 10 into 0.9 plus 8 is 17 of K. KD is 10% into 1 minus T is 7%. So KD 7, K is 17. What is the weighted average cost of capital? 13.8. Now you look at it. Economic value added is EBIT into 1 minus T into 250 lakhs multiplied by WACC give you EBIT of 9371,429. From the EBIT, if you deduct interest of 8 lakhs, from the EBIT, if you deduct the interest lakhs, you get PBT as 8571,429. From which, if you deduct, now it is a normal income statement. From the PBT, when you deduct 30% tax, it is PAT of 60 lakhs. Such an easy question. Question number 28 is. Question number 29. Great question from the chapter of Forex, or I can say international capital budgeting, right? Which is international financial management. 29th question, super ambiguous, completely senseless question. Let us proceed to solve. PQR Limited is considering a project in US. It involves initial investment of rupee 124.20. If they don't say anything, I am Indian, my home currency is rupee. I want to do invest in US, foreign currency is dollar. Initial investment coincidentally in my currency has been given. The project will have 5-year life. Current spot rate rupee per dollar is 83. Don't assume it to be Swift code because 83 looks like rupee per dollar and not dollar per rupee. 84 is rupee per dollar. Risk-free rate is given. India's risk-free rate given. USD cash inflow for the next 5 years have been given. In the next 5 years, from that project, from the US, how much will I receive? 30, 40, 50, 60, 70 lakhs. Fine. PQ are expecting net surplus of 1858 to be received after the closure of this project. This line had the ambiguity. When I read this line, I was like, there is over and above these particular cash flow. Towards the end of the project, I received this surplus. I thought it as a terminal value, but then they say there is no salvage value. So again, I'm not sure what's happening. PQR want to take a forward cover to protect from the exchange rate fluctuation, meaning to say for the next 5 years, these US dollars cash flow when I receive, I will need a forward rate to convert them to rupee, right? Fine. You are required to recommend a rupee dollar forward cover, the rate for rupee dollar for forward. At a point as like if I have been given the spot rate and if I have the USD and INR interest rate, I can apply interest rate parity theorem and calculate forward rate of respective years. But if I do it, I know I won't get marks because then why is the entire story? Then what? Then, which means it is some kind of reverse calculation. And in the reverse calculation, you have to understand that I have been given this particular amount. In the absence of information, I was not sure what to assume, but when I looked at the suggested, I realized what are the ambiguities this question has. Ambiguity number 1, they have assumed this particular thing as your NPV. Sir, how can NPV be called as net surplus? And how do you receive that NPV after the closure of project? No answer. This is your NPV. So using NPV, can you back calculate present value of inflow minus present value of outflow? Yes. In that inflow, there would be some forward rate using which these dollar cash flows would have been getting converted to the rupee cash flow. Yes, that forward rate you have to back calculate. Sir, how do we do it? And if it is NPV, where is the discounting rate? Examiner has again not given it. Assume the exam paper of November 24. Institute did blunders. Pointlessly, I don't know how can they ask a question in the exam where they don't solve it once at their own in the notebook. Unfortunate. Correct? Let us, people in the class, try to understand. They have given you 2 factors. Why? We don't know. 12 and 15% given. Why? We don't know. We can use one of the 2 factors, assume that as the WACC and use as discounting rate. So if I talk about the cash flows, think of it. Sir, these are cash flows given to me, respective cash flows. If I assume the forward rate, rupee per dollar forward rate, if I assume as F, then can I say rupee cash flow will be 30 lakh dollar multiplied by rupee per dollar rate, which is F. So 30 lakhs F will be, people in the class, my rupee cash flow. So rupee cash flow of respective year is this. Those cash flow, when I discount at the rate of 12%, I get the present value of cash flows. And NPV is present value of cash inflow minus the present value of cash outflow. The present value amount of investment is 124.5 crores. I know if this is in lakhs, let me convert it 12450 lakhs. Crores into lakhs is 12450. So this inflow minus outflow is NPV, which is given to me 1858.08. Solution is really easy, but interpretation of question to come to this solution is really difficult. Once you mug it up that this is the solution, it's really easy. But the problem is one would never realize. Now, sir, suppose when I solve it, I can back calculate the forward rate as 83.13. First ambiguity, rate is given. Second ambiguity, sir, same forward rate is assumed every year. Same forward rate is assumed every year, which means despite the rates of interest being different every year, the forward rate as per RPT will be different, but same has been assumed every year, and which is good for us that the question became really easy, but it is practically an ambiguity. Question 29th gets done. 30th question, again with a minute ambiguity, but is really a good question. Let's say what it tries to say. Mohan buys 10,000 share, listen to me, 10,000 share of X Limited at a price of 25, whose beta 1.5. Buy long position, sell short position, 5,000 share A Limited, 40 price, beta of 2. Obtains complete hedge by buying 25 Nifty future, long position in the Nifty future. Decide to close the position when the price is changed. Fine. Where share of X fall by 4%, Nifty future drop by 2.5, and overall loss is 16,625. Sir, what about A Limited's price change? Not given. The value of Nifty future. Every Nifty future has what value? Reverse calculation. Sir, value of Nifty futures. At what value the Nifty future cost was entered? Sir, when I have given the position already taken for 25 contract, apply the logic of, in the derivatives, which topic is this? Hedging using index future. So positive 25 is equal to value of the portfolio into beta target minus beta of the portfolio divided by price of every future or value of every future. Do I have the value of the portfolio? Yes, I can calculate 20,000, 10,000 share 25 each, 5,000 share 40 each. Please remember, 250 for 10,000 share of 25 each and 5,000 share of 40 each, 2 lakhs, but negative net portfolio value is only 50,000. Fine. Sir, beta target 0, what is the beta of the portfolio? So if I have individual shares beta, and if I have their market value being positive, negative, the weighted average when I do, the weighted average is negative 0.5 times, negative 0.5 times. With all this thing, can you calculate the value of the future? Yes, sir. Value of the portfolio is 50,000 multiplied by negative 0.5 is multiplied by 0.5 positive divided by 25 give me one futures contract will have a value of 1,000 rupee. That's get sorted. Logic, basic, easy, perfect. Initial cash outlay. Initial, how much did you invest in the portfolio? Sir, 50,000. No, sir, you took one more futures, like one more thing, which is 25 futures, where every future was 1,000. But did you pay anything when you enter into a future contract? No. This is the ambiguity. As per my logic, only in the cash market you end up paying something today. In the futures market you don't. But they considered an outflow of 25,000 for futures also, making my initial investment as 50 already long the net portfolio plus 25,000 for futures. You have to continue to follow this in the exam. Sir, next, cash inflow at closeout. At closeout, what is my cash inflow? If the initial investment is 75, where I made a loss of 16,625, how much will I end up ultimately receiving? 75 minus 16,625 is 58,375. Logic, basic common sense. Sir, next, percentage gain loss to A limited at the time of closure. Sir, if I have total gain loss, if I have individual, the other two positions gain loss, then A's gain loss can I find out? Yes. For example, I took 2,50,000 long position in X, which dropped by 4%. So long position drop is a loss. 2,50,000 multiplied by 4% is 10,000. Fine. 2.5 Nifty futures dropped. When I have a long position in 25,000 Nifty future, so 25,000 into 2.5% is 625 rupee loss. So out of total loss of 625, 10,000 is loss on X, 625 is loss on future. So net 6,000 would be the loss on A limited share, which, oh, they asked me for the percentage gain loss. My position is 2 lakh. Of on that amount, when you have 6,000 rupee of loss, so 6,000 multiplied by 2,50,000 is, sorry, 2 lakh is 3% loss in percentage terms. E part of this question I added myself for the class students. You can at this point ignore it. Question 30, that way people in the class gets done. 31 easy reverse calculation based question. Let's look into it. Portfolio manager, 3 mutual fund. We have been given the average returns. We have been given, for market we have not been given. We have been given the variance of the market and Sharpe ratio of the companies and the trainer ratio of the companies. Sir, risk-free rate 9%, calculate variance of the funds. You obviously realize that if Sharpe trainer is given, then some kind of reverse calculation is involved. Whatever is given, apply formula. Sir, return of the portfolio minus risk-free rate divided by standard deviation of the portfolio, Sharpe of 0.15 negative. Sir, return of portfolio is given, risk-free rate 9 is given, standard deviation of the portfolio, such a basic thing you can reverse calculate. Such a basic thing you can reverse calculate. So 7.5 minus 9 divided by standard deviation is equal to the Sharpe. Once you have standard deviation, square it up, you will get variance. Next, coefficient of determination, which is correlation between security and market square. Sir, now let's use trainer. Minus 2 I know is equal to 7.5 minus 9 divided by beta of growth. So that way I can have the beta of the company. When I calculate beta, it's just 0.75 times. So beta, which is 0.7 time, I know is correlation into SD of security, which is given to me as 10 divided by SD of market, which is 50.41 under root as 7.1. Using this formula, I can find out correlation, squaring which will be covariance. So correlation is beta is correlation into SD by SD. You get correlation, square is coefficient of determination. What you do for this security, you do for all. Question number 31. Such an easy thing of reverse calculation gets done. 32nd. Again an easy question of currency swap. You can call it either from the interest rate risk management, right? Such an easy question. Let me show you my handmade notes which we refer for regular batch students, because there I have presented the solution to this question. There I have presented the solution to this question in a better manner. 32 question is there in the chapter of Forex in our book. Forex, this is the question of, wait. Hold on for a minute. When I go to the out scanner, where do I find in the chapter of forex this particular question? Cool. 85th question of our out scanner. It is: True Life, US based company, has won a project to implement India. The first basic thing you should realize that this is a US company. When a US company does a project in India, the foreign currency is rupee, the home currency is US dollar. Unless you get this clarity of foreign currency, home currency, you won't know the final answer should be in which currency. As we have learnt it in the class, final answer should always be in home currency. The project will require initial investment of 8,000 million. Listen to it here. At 0 point, I need to invest 8,000 million rupee. Fine. The whole project along with the equipment will be sold for 9600 after a year. At the end of first year, the entire project will be sold for 9600, which means to me as a US company, I will have an inflow in rupee terms of 9600. Since the Indian government will pay the amount in Indian rupee, company is worried about the exposure. Today, as a True Life, you have dollars. Investment is 8,000, fine, which you will purchase, but the redemption is also in rupee. When you convert it back to dollar, you don't know what will happen. That is what your worry is. Construct a swap that will help True Life to reduce exchange risk. What kind of swap you will construct? Look at it. Is a typical question, has logic as well as some element of remembrance. So today, True Life has dollar, but it need rupee, so it can sell dollar and get rupee, right, at whatever is the spot rate. Fine, sir. Enter into a swap agreement to do the reverse thing again after a year. After a year, it will say, I will sell you the rupee back. Whatever 8,000 rupee I purchased, I will sell you the rupee back. And you give me dollar. And that agreement is entered today only at a whatever agreed rate. For example, agreed rate is 82. So at a rate of, suppose today's spot rate is 80, which you will see in the next part of the question, and agreed rate is 82. Then reverse transaction will happen at that agreed rate after a year. That kind of swap agreement they can enter into. Is a theory question. First part, theory answered here. Second part of the question. Assume that Indian government offers a swap at a spot rate which is rupee per dollar 80. Means today whatever is there. But after a year, Indian government has agreed to do a swap at a rate of spot rate which is 80 only. So the agreed rate of swap is 80, spot is 80. Fine. Sir, the spot rate after a year is expected to be 84. So EST, the expectation that the rate will be 84. Right. Further, assume True Life can take 6% loan. Whether we should opt for this agreement by the Indian government to do the swap at 80 or not. So we say, let's do calculation. Sir, today my home currency is dollar. All the inflows outflows should ultimately in dollars. Today, if the spot rate is 80, when I buy 8,000 rupee, how much dollar will I pay? $100 outflow. After a year, I will get 9600 here. Out of 9600, 8,000 I can sell back at a rate of 80 to the Indian government if the swap is agreed to. So I will get back 100 from Indian government. But 1600 is the profit element which remains exposed, right? So that 1600 I will sell at a rate of 84. So 1600 divided by 84 give me 19.05 on a rounded off basis the dollar received. Now, sir, the relevance of this line, since you can take a loan of 6%, so on this amount of 100 which you invest in the project today, if you borrow 6% in dollar terms only will be the interest cost. So overall 100 received from government after converting the rupee to dollar, 19.05 received from market this US dollar, 6 US dollar paid as interest. Net is the inflow as this. However, if I don't do swap, 80 is purchased, 8,000 rupees purchased at the rate of 80, $100 million outflow. The entire 9600 people in the class will be sold at a rate of 84 in the market because there's no swap agreement. 9600 divided by 84 is 114.29 on a rounded off basis. So when I sell this amount at this rate, inflow is this and interest of 6 is there, overall inflow is 108.29 USD million. Here inflow is 113, here inflow is 8.29. So due to swap, it is a better scenario. So I should opt to the swap, opt in the swap offered by Indian government. This is the solution to this question. I hope I have explained it on the timeline. So in the regular batch, with this example, you can understand all the questions of regular batch, right? If I show you the annotated handwritten solution to all the question, we have this timeline based explanation, timeline based understanding of the question, which makes this solution really easy and crystal clear to the students. At 0 point, we have this 60-day this, so discount it, apply respective rate, add interest, bring it to third month end kind of discussion we do in the class, giving you crystallized clarity to the students, right? Bringing you back question, sorry, which one? 32nd gets done. 33rd is November 24 MTP, which has no new practical question. 37th is a practical question, extremely easy. You can do it at your own. So easy that I don't even have to teach you. 37, but you must do. Right? November 24 RTP has no new practical question. So that way, everyone, September 25, May 25 and November 24. All new questions from RTP, MTP and exam papers. We have discussed them, solved them, understood them, right? From the scratch to what is needed, with explaining you the ambiguities and everything, right? So that was all from my side in this video. Everyone, let me tell you, we will also come up with the revision session on derivative, forex and portfolio management in the coming days. I missed to mention it in the initial part of this video. So I hope you watch it till here. Let's meet back live again in the revision videos. I hope the video has made sense. If so, kindly share it with your colleagues. Kindly subscribe the video and do like it. Yes, bye. Take care. See you all.